Hi everyone. Today we will explore an options strategy known as the short synthetic future. It is a specific method for expressing a bearish view on a particular stock. Think of it as an alternative to shorting shares directly. This strategy is designed for moments when you believe a company's stock price is set to decline. It is not an income-generating plan, but rather a capital gains strategy. You are positioning yourself to profit from a downward movement in the market price of the underlying asset. The core idea is to replicate the risk and reward profile of a short stock position, but by using options contracts instead of borrowing and selling shares. Shorting stock involves borrowing shares, selling them, and hoping to buy them back later at a lower price. This process can be quite costly, often involving borrow fees, and it always requires a margin account. The short synthetic future can sometimes be established with a lower initial cash outlay, depending on the price of the options. It offers a degree of flexibility that many traders find appealing. However, this flexibility does not eliminate risk. The potential for loss can be just as significant as with a traditional short sale. This strategy is most effective in a bearish market environment for traders with strong research-driven conviction. Let us break down the two components of this strategy. The first part is buying a put option. A put option gives you the right, but not the obligation, to sell a specific stock at a set strike price and expiration date. If the stock falls significantly below the strike price, the put gains value because it lets you sell above market price. The second component is selling a call option. When you sell a call, you receive a premium in exchange for the obligation to sell the stock at the same strike, on or before the same expiration. If the stock rises above the strike, the buyer will likely exercise. You would be obligated to sell at the lower strike, creating a loss. This short call is the position's primary risk. Choosing strike and expiration is critical. Traders often pick a strike close to the current price, at the money. Pick an expiration that matches your forecast. Shorter if the drop is near, longer if decline may take time. Longer dated options cost more, but give the trade more time to work. Long put plus short call. Counter synthetic short. If price falls, the long put gains value, and the short call likely expires worthless. Result, profit. If price rises, the long put goes worthless, and the short call becomes a growing liability. Result, loss. Net effect, the PL mirrors a short stock position. Your profit grows as the stock falls, and your potential for loss increases as the stock rises. That's the gist. To make this concept clearer, let us use a practical example. Shell plc. We will use simple, rounded numbers for the sake of clarity. Imagine that today, on the 28th of October 2025, Shell shares are trading at exactly £20 per share. After analysing the energy market, you have formed a bearish view. You believe Shell stock is likely to fall over the next 3 months. You decide to implement a short synthetic future. Select the strike price. Select the expiration. You choose the at-the-money strike of £20 and an expiration 3 months from now, January 2026. Buy a January 2021 put for £150 per share. Sell a January 2021 call and receive £1.20 per share. Execute both trades. Net debit, 30p per share. One contract equals 100 shares. Total initial outlay approximately £30 plus fees. Now your position is open. Right to sell 100 shares at $20. Obligation to sell 100 shares at $20. Until January expiration. Maximum profit. Large. Limited only by the stock falling to zero. Maximum loss. Unlimited, because there is no ceiling on how high a stock's price can rise. This risk and reward profile is identical to that of shorting 100 shares of Shell stock directly. Alright. Let us explore what might happen to your Shell trade at the expiration date in January 2026. We will consider 3 distinct scenarios. We will ignore the minor impact of brokerage fees and interest for simplicity. Your initial cost was 30p per share. This initial debit is the most you can lose if the stock finishes exactly at the strike price of £20 at expiration. Scenario 1. Shell's stock price falls significantly to £10 per share. Your long put option is now in the money by £10. It gives you the right to sell at 20 when market is 10, making the put worth approximately £10 per share. The short call expires worthless. Your gross profit is £10. After subtracting the initial 30p, your net profit is £9.70 per share, or £970 for one contract. Next, imagine the stock rises sharply to £40 per share. Your long put is worthless. The call you sold is now a major liability. To close it, you would have to buy it back for approximately £20. Your total loss would be £20 plus your initial 30p, a net loss of £20.30 per share, or £2,030 for the contract. Finally, if the stock closes at exactly £20 at expiration, both your long put and short call are at the money and would expire worthless. Your only financial consequence is the loss of the net premium you paid, £30 for the contract. This shows a small defined loss if the price remains stable. Entering into a short synthetic future position requires a methodical approach. It is not a trade to be entered into lightly. Following a clear set of steps can help ensure you have considered all the important factors. Identify a stock you believe is poised to fall, based on thorough research and analysis, not a whim or a rumor. Select an appropriate expiration to match your thesis. A shorter-term expiration of 1 or 2 months may suit an earnings-driven drop. A longer horizon may need 6 months or more. Longer-dated options cost more in time premium, but give your trade more time to be correct. While at the money is common, you can choose out-of-the-money strikes to reduce cost, noting they require a larger downward move before becoming profitable. Place 2 simultaneous orders: buy to open the put and sell to open the call. Check your broker's margin requirements. Because you are selling an uncovered call, capital will be set aside as margin, and it can change as the stock moves. Ensure you have sufficient funds to meet the initial margin and any potential increases, known as margin calls. Once margin is confirmed, the net premium noted, and risks accepted, execute the trade and begin monitoring your position. Active oversight is part of the strategy from day one. Once your short synthetic future position is open, active management is key. You should not simply set the trade and forget about it. There are several ways to exit, depending on trade progress and whether your outlook has changed. The most common method is to close both legs before expiration. Sell to close your long put, and buy to close your short call. This liquidates the position, locking in whatever profit or loss has accumulated. If the stock has fallen and you have a handsome profit, you might buy back the short call to eliminate upside risk, leaving only the long put to continue benefiting if the stock falls further. If the stock begins to rise, you might close the position to cut losses, or sell the put to collect residual value while reassessing the short call. If the stock rises above your £20 strike, the call buyer may exercise. You can be assigned and must deliver 100 shares at £20. If you do not own shares, your broker typically borrows and sells them, creating an actual short stock position with its own risks and costs, including covering any dividends while short. You could let options expire. At or below strike, both may expire worthless, or your put may retain value. Above strike, the short call will likely be exercised. In most cases, proactively close before expiration to maintain control and avoid assignment surprises and costs. Having a clear exit plan before you enter is a hallmark of a disciplined trader. Understanding margin is not just important, it is absolutely essential. Selling a call without owning the stock is a naked or uncovered call, one of the riskiest positions in options trading. Brokers require collateral called margin, not a down payment but a good faith deposit to cover potential losses. Initial margin is required at order entry and is calculated using factors like stock price, volatility, and time to expiration. A long put offsets some naked call risk, yet most brokers still demand significant margin. Margin is marked to market. If Shell rises, required margin increases. If funds are insufficient, you receive a margin call demanding more cash or securities. Failing to meet a call can trigger forced liquidation. Your broker closes the short call at market, locking in losses, often at the worst time. Maintain a substantial capital buffer. Undercapitalization is a quick path to catastrophic loss with this strategy. A defining characteristic of the short synthetic future is its symmetrical, and potentially unlimited, risk and reward profile. As the price drops below your £20 strike, the long put gains value pound for pound. If price fell to zero, maximum profit equals strike minus net premium. The short call drives risk. Because price can rise indefinitely, potential loss is uncapped. A sudden takeover spike to £50 or even £100 would produce enormous losses. This mirrors a traditional short stock position. To cap risk, a trader could buy a higher strike call, turning the short call into a bear call spread. That insurance caps loss, but adds cost and changes the profile. For the pure short synthetic future, uncapped risk remains inherent and must be managed carefully. In summary, the short synthetic future is a powerful but demanding option strategy, constructed by buying a put and selling a call with the identical strike and expiration. It behaves like a short sale of the underlying stock, a tool for traders with a bearish outlook. As we saw with Shell, it can be initiated for a small net cost and offers substantial gains if the stock falls. However, profit potential is matched by significant uncapped loss on the upside. Risk is managed through margin, which demands significant capital. Be mindful of early assignment risk, especially around dividends, and the consequences of failing to meet a margin call. It is not for beginners. Approach with extreme caution and discipline. Always start small, risking only a tiny fraction of your portfolio you can afford to lose. Ensure a predefined exit plan, including a stop-loss point, and remember, successful trading is about managing risk. The short synthetic future offers a bearish alternative, but no shortcuts. Understand mechanics, respect unlimited risk, and prepare for when things go wrong. Well, that's it. Good luck with your trading. Thanks for watching and see you next time.